Hello everyone, welcome back to another episode. I'm your host, the Millennial Investor, and today I wanted to go over some information and I wanted to be going over how stocks differ from both dividend growth to dividend yield and which ones you should be factoring more into your portfolio. Is it great just to focus on a 3, 4, 5% yield and not really worry so much about the growth or retainability of that dividend? Or is it better to focus on the lower yielding stocks like a Microsoft or Apple that yield around 1% but have huge growth potential over the next decade or two? We're going to be going over all of that, and in this video I'll be breaking down the comparison of a 3% yielding stock with 5% growth versus a 1% yielding stock with 10% growth and how long it takes that stock to catch up. We're going to be comparing the two main stocks, the two big tech stocks that everybody likes to talk about, Apple and Microsoft, versus 5 of my top blue chip stocks like Pepsi, 3M, McDonald's, Coca-Cola, and Caterpillar, and then we're going to compare their dividend growth over the last 5 years and their average dividend raise and see how it matches up with Apple and Microsoft and see if there's a huge difference and if it's worth enough to even buy into these stocks based off of strictly their dividend. Now, if you're not familiar with me, if you don't know who I am, my name is Jordan. I'm the Millennial Investor, and basically to give you an idea of what I do on my channel, I track my annual dividend income on this chart right here, my monthly dividend income right here, my portfolio value right here, and then I also track my YouTube income, which is something that hardly any other YouTubers out there disclose. So if you appreciate the transparency and you like that I show every single thing on my channel, even breaking down all of my expenses and all of my revenue, and I will be updating these numbers monthly, and so I'll be adding that in just a moment. But if I go over here to my main page, if you want to support me and you're new to the channel and you're interested in using M1 Finance as I go throughout this video, if you see something new with M1 Finance that you haven't seen before with other brokerages, or if you're getting new to investing and you want to get started with a great brokerage, there's a free brokerage right here called M1 Finance, and they have a great platform. And this link that I'm highlighting right here is in the description in all of my videos. Not to mention there's lots of other stuff in the description as well, not just referral links. So go check out the description because there's lots of other stuff in there that you can use. Now let's go ahead and go to my activity page here. Let's go to my morning trading. And then you see here, I had a $92 sell in Microsoft. I sold the shares that I did have in Microsoft, which I only had about 0.44 shares. And then I replaced it. You see my big buys here. I replaced it with $35 into JP Morgan. I replaced it with $33 into 3M. And then I replaced it into 36 with Caterpillar. So 3M, Caterpillar, and JP Morgan I will be going over at the end of the video and why I buffed up these positions over Microsoft, and I completely sold out of Microsoft. And while I did have 31 stocks, now that I'm out of Apple and Microsoft, I now have 29. So I'll be going over that. But let's go ahead and look at a hypothetical situation. Now I wanted to give an example here. Now I wanted to show you how long it would take these tech stocks to hypothetically compare to a blue chip stock like a Pepsi or a Coca-Cola. Now, the example that we're going to give is a stock that has a 3% yield. And now if you want to look at these current yields here and how it compares to this example, Apple has a 0.073, Microsoft has a 0.96, Pepsi has about a 3% yield, 3M 3.7, McDonald's 2.4, Coca-Cola 3.4, and Caterpillar about a 3. So you can see how this compares with this example that we're about to give. So with the stock yielding 3%, it's going to grow 5% hypothetically, like clockwork, 5% even every single year. And feel free to punch all this in your calculator to see that everything matches up, because I promise you this is actually the truth. And we're going to be comparing it with a 1% yielding stock, which is pretty close to what an Apple or Microsoft trades at. And we're going to say that hypothetically they raise their dividend 10% every single year without fail, no good or bad years, just 10% every single year. And you can see how this starts off. There's a huge gap with a higher yielding stock, and then it gets closer and closer, and I'll slowly scroll through if you want to pause through any of these. And then finally, when we get all the way down to year 24, that's right, year 24. So if you're watching this right now and you're 30 years old, your dividends wouldn't even catch up on a stock like Microsoft compared to a Pepsi until you are 54 years old, if you're watching this when you're 30 years old. Now, one thing that I do want to mention here, if I were a betting man, I would bet that strictly in share price, a Pepsi or a Coca-Cola will underperform compared to a Microsoft. You can see in the last 5 years, Microsoft has went up 330%. Now, I do think that will probably slow down in the next coming years, but who knows? And you compare that to, say, like a Coca-Cola, for example, that is only up about 10% in the last 5 years. And Pepsi is not too far behind it. Pepsi has went up about 35% or so in the last 5 years. But anyways, that's not the point. The point is, in the long run, I'm sure in share price, Microsoft will probably beat these other two stocks, but we're not focusing about share price. We're focusing strictly on their dividend and their dividend growth. I want to focus on a dividend investor, as the dividends dividends that you would receive. I don't want to be focusing on M1 Finance on stocks that are going to go up a ton in share price. I want to get stocks that can give me great yields. Now, we showed these current yields earlier, and let's look at the dividend growth over the last 5 years. So this is total dividend growth. So this is from 2015 to 2019, and these are the last 5 years that I showed. Obviously, 2020 I did not use because some of these stocks have not raised their dividends yet, like Microsoft hasn't, and I believe Caterpillar hasn't yet, and I don't think McDonald's has either. But when we look at the last 5 years, 2015 to 2019, Apple in the last 5 years is the leader. I sorted this from greatest to least. Apple has went up 48.07. Okay, not bad. Microsoft 41.66, 3M 40.48, McDonald's 40.44, Pepsi 35.84, Caterpillar 33.76, and then last but not least, we have the one that's really lagging behind the rest. We have Coca-Cola only going up 21.21%. Now, regardless of how much the growth is, any dividend growth is pretty impressive because not only are you getting a great yield, but you are getting that dividend growth. And even though Coca-Cola is by far the farthest behind, even 21% growth over the last 5 years is still not that bad. That's averaging over a 4% raise annually. So that's nothing to shout home about, but that is a pretty decent dividend raise. But comparing to the others, it does look like a pretty big laggard. Now let's look at the average dividend raise over the last 5 years. When we compare this to the others, you can see that there is a difference in these high-tech growth stocks, but it's not anything that's a significant, huge, massive difference. So let's look at Apple. Its average is 9.61, Microsoft 8.33, 3M 8.09, McDonald's 8.08, Pepsi 7.16, Caterpillar 6.75, and then Coca-Cola at 4.24. Now, y'all want to show you something here. Even in the scenario we gave with the 5% difference in growth. Now with Coca-Cola, even if you were to compare the slowest compared to the fastest grower, even in this scenario, it's only about a 5.4% difference. So not anything massive, and that's completely opposite ends of the spectrum. Now when we compare it to some of the higher growers compared to like a Microsoft, which has not grown anywhere near double digits, it's only 8.3. 3M is only 0.2 behind it. It's actually less than 0.2. It's actually like 0.14. Now, when you look at 3M and McDonald's, they're not that far behind Microsoft. We're talking fractions of a percent. And even when you compare these two compared to an Apple, they're only about 1.5% behind, not that far at all. And the same thing with Pepsi. It's only about 2.5% behind Apple, and only about 1.2, 1.3 behind Microsoft. So you can see that the growth is not that big of a difference. So I think when you're just talking about dividends, when we're not talking about share price growth, we're not talking about business models, we're not talking about opportunities for the future, I'm strictly talking about dividend yield versus dividend growth. When you see that the difference is not anything significantly different for these blue chip stocks, there's not a lot of whole potential for me to own these stocks unless they become at a significant discount like they were back in April and May when I was buying these stocks originally. Believe it or not, when I sold Apple, let's go ahead and go to my history here. I sold Apple, let's sort by trading. When you go to when I sold Apple, right here. Yeah, so by the way, I buffed up my position in JP Morgan again, and then I also bought some more Altria with that money, by the way. But with Apple, I sold it for about $420 a share. $420. When I first bought this in April, I had an average share price of $250. Now, I had such small quantity of the stock that it wasn't even close to a $170 gain, but $250 a share is what I bought it at. If Apple was still trading at $250 a share, I would never sell it. I would still be buying more, my dividends would be a bit more significant, and I would also be buying it at a much better valuation. And the same thing with Microsoft. I sold it at 209, basically 210 bucks. I believe when I started buying the stock, I want to say I bought it around 140, 150, somewhere around that. So a big difference in the matter of just a couple months. So like for example, when I use the Altria trade, which whether or not people agree with that, who knows, but if they are able to keep that dividend, I bought it at 40.93. Did you know that at that share price, if they maintain that dividend, which it is at a decent risk, but who knows, if they maintain that dividend, that's locking in about an 8.2, 8.3% dividend yield. Think about what I just said for a second. 8 point something percent dividend yield. So I'm automatically locking in 8+% gains as long as that dividend is held, and that doesn't even count share price gains. The same thing with JP Morgan. Not only do I think that they have a great dividend at these prices, but I think they have an excellent opportunity. But overall, guys, I just wanted to show you these differences in dividend raises and dividend growth over the long term, and how yield is sometimes a little bit more important than growth, but I think you should equally factor both in your portfolio. If you go through this broadly through my portfolio and you see some of the big names here, I have stocks that have a mix of high yield, some that are really high growth. So like to start, Broadcom, Realty Income, Southern Company, these are all 4+% yielders. And then one of my top holdings, Visa, it's less than a 1% yield, but they have an average raise of like, I think it's around 15% annually. So they are a huge dividend grower. 3M, a very old blue chip, blue chip, blue chip, but I also have some more higher growers here throughout the portfolio. And I think it's easy to focus on just yield when you're a dividend investor, but you should equally focus on both. But I hope that gave you a little bit more insight to what both of these stocks have to offer when it comes to both a dividend yield and a dividend growth perspective. But let's go ahead and look at the three stocks that I decided to buff up. I sold Microsoft and I buffed up JP Morgan twice. I buffed up Altria, I buffed up 3M, and I also buffed up Caterpillar. So the reason why I bumped up these four different stocks, I'll be going through them one by one. We'll sort from lowest to highest. So let's go ahead and look at Altria. Like I said, basically the way I look at it is that I think that they're going to be able to maintain this dividend. You can see the big jump up there. I think that they're going to be able to maintain this dividend. The CEO, the board of directors have all said that they are completely committed towards keeping that dividend, and they have raised it every single year for such a long time. It's 84 cents now. Now it's up to 86 after this raise. Not to mention, forget the dividend for a second. Let's just talk about share price. These guys are at rock bottom valuation. You can see this was the exact same company 2017. They're at almost $80 a share. Today they're trading about half that price. Now they got killed in share price because they got fined a lot for their significant stake in Juul. But now that that is finally coming to an end, a lot of those fines that they experienced over the last 2 or 3 years are finally coming to an end. And I think that picking up now at a decent valuation and at an amazing dividend yield, I think I'm worth taking the risk for that risk of cutting the dividend. Now next, let's go ahead and go to the next one that I beefed up, and the one that I beefed up twice. JP Morgan. I just think you can see the two big jump ups there. I think JP Morgan, in my opinion, it's an incredible stock to buy at these levels. Now, first off, share price, it is at $140 a share, and this is the stock last year. It produced tens of billions of net income. Not tens of billions of revenue, tens of billions of net income. Think about the financial power that the largest bank in the world, JP Morgan, has. They are such a well-run bank. They always find a way to just outperform on their investments, and they are so good at returning money back to shareholders. Not to mention, they have one of the highest yields that a big bank can pay right now. They're paying about a 3.5% yield, and they were even a little bit higher than that the other day. They had a couple green days. They were almost a 4% yield when I buffed them up twice last week, and I just think JP Morgan, it's an easy money stock. If you see JP Morgan trading at $100 a share at these levels, pretty much lower than what it was trading at back in 2017, if you're buying JP Morgan at these levels with that great dividend, which I think is going to be relatively safe, I think that is an easy money stock. Buying the stock, it's almost like guaranteed gains. Next, look at the next stock that I bumped up. Let's look at 3M and let's look at Caterpillar. Let's go ahead and look at Caterpillar next. Caterpillar, I bumped up twice since inception of the portfolio. I bumped it up about a month, 2 months ago. And with Caterpillar, I just think they're at a great position to grow for the long term. Now, I have mentioned the potential opportunity for an infrastructure bill that Donald Trump has talked about passing for $1 trillion. Now, if that happens, this is going to take the stock to the moon. It is going to take it to a different category. Now, that is just kind of a wild card there for Caterpillar, but let's say that never happens. Let's say that never goes through. I think the dividend growth, being as significant as it is, over a 3% yield, and that the fact that it has such a good share price to buy it at now, I would rather buy it now while times are tough and get paid dividends in the meantime, and then wait for that share price to recover. I don't think that the stock next year or 2 years from now will be back at 170. I think it'll be close to 200. I am very bullish on the stock, and the fact that they're an industrial company and they do so well really makes me bode well for the stock, and I think anyone should buy the stock for the long term. And speaking of industrial companies, for any stock that every single investor should buy for the long term, we're going to look at 3M. I love 3M, and God, I especially love it at these prices. You can see it's basically flat over the last 5 years, pretty much went nowhere. You can see the dividends went from $1.03 up to $1.47, pretty good growth, and it is yielding 3.5%. The valuation on this company is a lot lower than pretty much any other dividend king you could find out there. When it comes to these stocks that I'm buffing up in my portfolio, when I just see 3M at this prices, if I were forced, guys, I would have no problem whatsoever even making a bigger position in 3M. I just think at these levels, it has incredible financials, and they're so diversified. They have 56,000 products. 56,000. You heard me right. So they're so diversified in all different factors of the economy that I don't really see a scenario where they ever really go down and they ever go bankrupt. I think that they're going to be just fine, and they are a dividend king with over 50 plus years worth of dividend raises. But that wraps it up, guys. That's pretty much it. That's all I have for you in this video. If you're new to the channel, consider subscribing. If you want to support me, like I mentioned at the beginning of the video, please go check out the description. Even if you don't want to sign up for M1 Finance, there's lots of great stuff down there. This link is in the description of all of my videos. If you're interested, we have 20 people that are signed up. Do me a favor and go ahead and be the 21st person to sign up. Go ahead and support my channel, and more importantly, help this dividend growth portfolio grow. If you want to see this number get to 4,000, 5,000, 10,000, every time you sign up, every time you watch an ad, anytime you sign up for me with a mentoring call, anything that can help support the channel, 100% of my earnings go straight back into the portfolio. So thank you guys so much for watching if you made it all the way to the end. If you have any comments for me, go ahead and leave them down below in the comment section. I appreciate you guys very much. I love you guys. Thank you very much. I'll talk to you later and see you guys next time.